The shopping landscape has changed in the recent decade. The retail apocalypse began in 2010, and since then, many North American retail stores have struggled to stay above water. Over 12,000 physical stores are gone. Here are some of the companies that couldn't survive the catastrophe. Number 23, Victoria's Secret. With all of their fashion shows aired on TV and their famous models, nobody would have guessed this lingerie store would close. While Victoria's Secret isn't disappearing entirely, they did announce they were closing 53 stores this year. In any given city, you'll find at least 5 Victoria's Secret shops, but 53 is 3 times the number of stores that shut down in a typical year. It may be hard to believe that with all the skin that's shown on Instagram posts nowadays, but analysts say women are opting for more comfortable underwear than the skimpy lace items sold at Victoria's Secret. Number 22, JCPenney. It's not news that JCPenney has gone through difficult times in recent years. JCPenney was founded in the early 20th century, so it's sad to see such a classic company go. In 2017, the company closed 139 stores. Even with a continuing decline in sales every month, JCP saw the closing of the stores not as a slow goodbye, but as a way to better evaluate what's happening. JCPenney's CEO, Jill Sautu, is convinced the company will see profit again. Number 21, Kmart. This year, Kmart closed 48 stores, once part of the big 3 discount retailers alongside Walmart and Target. Kmart's era is coming to a close. In the past 10 years, Kmart stores have closed in rapid succession. Last year, over 150 Kmart stores closed. If we rewind to 20 years ago, over 2,200 Kmarts existed. Today, less than 400 stores remain. Kmart is owned by the same company that owns Sears, a department store facing its own problems right now. More on that later. Number 20, Francesca's. Fast fashion retail store Francesca's is for the more girly and conservative young woman in the world. Fast fashion retail store Francesca's is for the more girly and conservative young women in the world. Inside, you'll find clothes, accessories, and even cute little gifts for your best friends. There's a Francesca's in most malls, but perhaps not for long. Sale percentages have fallen by double digits as of late. This year, management has reported that they would close 30 to 40 stores, and as many as 129 in upcoming years. Number 19, Target. The store everyone ends up spending more money than they planned. Target may have a hold on its loyal shoppers, but even this major discount retailer has its troubles. Earlier this year, Target announced they would be closing 6 stores by February 2019. It's a small number compared to the other companies on this list, but it is surprising because you wouldn't think Target would be suffering any losses. Even with some of the shutdown properties, Target plans to open 20 new locations this year. Number 18, Sears. It looks like Sears Holdings needs a new game plan. Last year, Sears had 766 stores. This year, as many as 241 Sears department stores might end operations this year. Whatever retail magic companies like Sears and JCPenney had 100 years ago, they don't have it anymore. In 2018, Sears Holdings declared bankruptcy. Chairman Eddie Lampert offered a $5.3 billion buyout bid, enough money to keep 400 of their most profitable locations going. Number 17, Gymboree. Some of you may not have been to Gymboree since you were an infant. Others may be going there again now that they have kids. However, the number of people actively shopping at this clothing store has significantly decreased. Gymboree declared bankruptcy 2 months ago, leading to 800 stores shutting down. Even though the company reduced its debt from $1.4 billion down to $500 million in 2017, it wasn't enough to save the majority of their establishments. Number 16, Starbucks. Within 1 block of a major city, you could pass by 2 or 3 Starbucks cafes. On a typical year, Starbucks closes around 50 stores. Now, that amount has tripled. Every year, this brand seems to create viral news for itself with its seasonal drinks and cup controversies. So what gives? How come they're closing 150 coffee shops? Starbucks says they are just weeding out the weaker locations to save money and open new shops in places that don't have any or as many Starbuckses. Yes. Number 15, Kohl's. In January, an SEC filing for Kohl's revealed that the company was closing 4 stores this year. All these stores are either located within or close to a mall, and Kohl's believes their shoppers prefer their strip shopping centers locations. Even with this handful of failing stores, the department store chain is going strong and is one of the few brands suffering the least from the retail apocalypse. Number 14, GNC. GNC owns over 8,000 locations worldwide, with 3,000 of those in the US. Now they plan to shut down 200 of them. In the next 2 years, they're planning 500 to 700 more closures. The vitamin shop chain is now moving its sales online to save money on the leases of their physical store locations. Though they earned $580.2 million in revenue last quarter, they also had a net loss of $8.6 million. Number 13, Lord & Taylor. Hudson's Bay, which is also the parent company of Saks Fifth Avenue, now owns the Lord & Taylor department store chain. Hudson's Bay said they are going to close 10 stores in 2019, which includes its flagship store in New York's famous shopping area on Fifth Avenue. That location has been around for over a century, but was sold to WeWork for $850 million. With less physical stores, Lord & Taylor teamed up with Walmart to augment their online sales. Number 12. Henry Bendel. Another high-end apparel store on Fifth Avenue going out of business is Henry Bendel. This upscale brand has been around for 123 years. In 2018, they only earned revenue of $12.6 billion. The stocks were down 55%, making it one of the worst performing companies according to the American Stock Market Index, S&P 500. Number 11. Shopko. Wisconsin-based real chain Shopko was founded in 1962. In January of 2019, Shopko filed for Chapter 11 bankruptcy. This filing allowed the company to reorganize amid bankruptcy. Shopko shut down 2/3 of its locations in the West, Pacific Northwest, and Midwest. While Shopko made a name for itself by going into smaller markets where more larger corporations were not present. However, Amazon has taken over the market and it's been downhill for Shopko since. Number 10. Lowe's. There's much more competition for department stores, clothing companies, and restaurants, but even the home improvement industry is seeing a dwindling in profits. Just look at Lowe's. According to its third quarter earnings report, Lowe's is closing 20 of its unperforming stores in the United States. They're also closing 31 stores in Canada. With 51 locations gone, Lowe's still owns over 2,000 more sites, so all is not lost. Many of the Lowe's newly closed units are within a 10-mile radius of another Lowe's anyway. Newly appointed CEO Marvin Ellison explained that their downsizing is necessary to create a stronger business. Number 9. Family Dollar. In 2015, Family Tree bought the Family Dollar chain for $8.5 million. Last year, Dollar Tree already axed 120 locations. As of now, 390 more Family Dollar locations will close, and 200 more will be converted into Dollar Tree stores. The 1,000 remaining stores are scheduled for renovations and will include alcohol sections and Dollar Tree merchandise. Some people believe that Dollar Tree should have never bought Family Dollar because the two companies were too different. However, Dollar Tree earned nearly $22 billion last year, so maybe something's going right. Number 8. The Children's Place. Where are parents of small children going to buy clothes now that Gymboree and the Children's Place are going out of business? The retailer plans to close 300 stores by 2020. So far, they have about 100 more to go before they reach that goal. Currently, they have 988 locations, though they began their downsizing initiative back in 2013. Luckily, the Children's Place isn't in deep water when it comes to losing sales. If anything, their sales are steady, but they still want to cut costs to remain profitable. Number 7. Chico's. Chico's used to rule the market when it came to selling clothes to the middle-aged woman. Chico's also owns similar brands like Soma and White House Black Market, which have also seen a decrease in sales. At the start of January 2019, Chico's said they were closing 250 stores in the next 3 years. They explained they wanted to have a more prominent presence online and do away with the more outdated aspects of the brand. Number 6. J.Crew. Preppy fashions have seen a dip in popularity in the last decade. If you look back to the 2000s, a preppy clothing brand like J.Crew was at the top of the profit charts. Now, not so much. J.Crew has closed 6 clothing stores throughout the US for 2019. That doesn't seem like a huge loss, but they already shuttered 50 stores last year. J.Crew's CEO, Jim Brett, stepped down in 2018, and now 4 new executives are trying to lead J.Crew back to the top. At least the J.Crew owned brand, Madewell, is still trending. Number 5. Ascena Retail Group. Ascena Retail Group owns brands like Lane Bryant, Ann Taylor, and Justice. These places adhere to different demographics of females, yet Ascena can't seem to make their businesses work as well as they want. They own almost 5,000 apparel stores in the U.S., making it one of the most spread out companies on this list. In 2017, the retail group planned to close up to 667 stores for the next 2 years. As of now, Ascena closed 31 stores and is on the track to close more. Number 4. Charlotte Russe. Charlotte Russe is like Forever 21, but not as well received. This fast fashion chain was founded in the 70s. As of March, they will liquidate all of their stores. Earlier this year, Charlotte Russe filed for bankruptcy and only wanted to close 94 of its 512 stores. Their strategy was to use bankruptcy as a way to eliminate their debts and hope another company would buy them and stay in business. However, liquidating company SB360 Capital Partners won Charlotte Russe in a bankruptcy court auction for $160 million and prompted for the company to shut down. Number 3. Gap. Remember the days when shopping at Gap was all the rage? However, the youth is now opting for more affordable, on-trend stores like H&M and Forever 21. The Gap is closing their stores little by little, and in the next 2 years have the intent to close up to 230. Its third quarter earnings report showed profits declining at 7%. On January 20th, 2019, they shuttered their New York flagship store. Number 2. Payless Shoe Source. Payless served as a supplier of trendy footwear that was reasonably priced. They were famous for their BOGO, buy one get one deals, which allowed you to bring home 2 pairs of shoes for the price of 1, or 1.5. We must bid Payless goodbye since they could not compete with cheaper online stores. In the past couple of years, Payless has gradually been shutting down stores. In February, they said they were going to close the 2,100 stores' remaining locations in the US and Puerto Rico. Before we tell you number 1, we have a question. What's your favorite store? If you heard that they were shutting down, how much would you be willing to spend on their last items? Let us know in the comments below. Number 1. Macy's. If there's one quintessential American department store, it has to be Macy's. Why else would this company host a Thanksgiving parade every year? Let's see how things are looking for them. In August 2016, Macy's announced they were closing 100 of its 728 stores throughout the next few years. For a long time, Macy's earnings were falling. In 2018, 80 of those 100 stores were closed. Fortunately for Macy's, they made some progress this past holiday season, though it was not near what their previous success reached. For 2019, they confirmed 8 store closures. Whether or not Macy's will have a complete shutdown like Payless is still up in the air. Thank you for watching. If you like this video, give it a thumbs up. For more, subscribe to our channel and turn on that bell notification.